I'm Malik. I'm a partner at CFGI. I lead our fintech and digital assets practice, along with my fellow partner Brian Powell at the back. It's incredible to see everyone over here. I've been in this industry for near a decade now. And I think that the one part that I like the most about it, and every year when you go to like the EDAS conference with others, you see that evolution. It's how organizations in this space have evolved over the last 10 years on the whole, but even over the last 4 years. We've gone from companies who are scrambling to get their books in order to now actually thinking about scale and transformation and IPO. And that type of rapid evolution is just unheard of. It's amazing to see, and I'm just proud to be involved with that.
All right, awesome. I am excited for this panel because of we had great discussions before this, so it's awesome. And of course, since nothing happened this year in accounting and crypto, so I think we'll figure out what we'll have to say today.
It's a slow year.
Yeah.
We're pretty quiet this year.
So I think the way I want to start is there are a number of topics I think that happened this year. I think there's SAB 121 and then 122. There is stablecoin stuff. There's trading stuff. There's a lot of things that happened. Maybe we'll start at the top. SAB 121. The Genius Act happened, and I feel like I've forgotten everything that happened before that. So maybe we start with Dr. Smith. What was SAB 121? What is 122? What's happening there? Just a basic intro, a little bit.
Okay, perfect. So do you all want the actual answer? What do you want the PC answer?
No.
Okay. Thank you, Cassie. No. So to how I viewed it, right? SAB 121. It was a deliberate attempt by the prior head of the SEC to really, I would say, make it almost impossible for firms, be they TradFi institutions or other institutions, to hold crypto on balance sheet, right? Due to the reporting and the disclosure components that were part of SAB 121. That's why I was so happy when I guess, and it actually happened on a bipartisan manner, which is odd, that SAB 121 got rolled back and it got replaced by SAB 122. And I will hand it off to Cassie and Malik if they want to add anything more on that.
I definitely think SAB 122 was a self-correction of there was positive intent, there was, the restrictions for wanting to protect investors and retailers and the smaller man and making sure that everything was transparent and compliant. And then it just wasn't operationally functional. And so reversing that kind of shows, hey, we want crypto to excel. We want to be able to have big players to make big changes and to test how this works, but it's not going to happen with 121. And so, Malik, I don't know if you had anything you wanted to add.
I absolutely agree. And I think what we start seeing with 121 rolling off and 122 coming on is some of the limitations, to Dr. Sean's point, that was put in on those organizations have gone away. Now it's almost a level playing field. Your traditional custodians for securities have the same guidance that's applied to crypto custodians. And I think that was the biggest limiting factor, because just as a reminder, what SAB 121 did was it enforced each of those custodians to hold all of the assets on the balance sheet. And in crypto accounting, accounting nerd term, when you have the assets on the balance sheet, you need to have reciprocal capital for it. So that means there was a significant tightening of the capital that these organizations had available to grow. With 122 coming out, all of those assets go off balance sheet. That means now the native crypto custodians have more capital they can play with, more capital they can invest in their structure. But at the same time, your traditional custodian banks, traditional banking organizations, they can also enter this space without having to worry about how that impacts their capital.
That's a great summary. Let me ask this question, which is that how much of the problems of SAB 121 did it solve? So are you predicting, consolidation of custodians and banks? Is it in terms of adoption with that change, or what are you expecting?
I think if I were to take a stab at that, what 121 was trying to do was, to Casey's point, right? It was also focused on investors.
Yeah.
And the users of those assets and what information is available to them, how are they safeguarded. I think 122 did cover that aspect as well.
Yeah.
Yes, the on-balance sheet element went away, but you still have detailed disclosure requirements. Those disclosures talk about, similar to any other custodian, how the assets are held, what are the controlled environments, what are the safeguards, so on and so forth. So for users of those organizations, for investors in those organizations, they're still getting the information that they're looking for. Just off balance sheet as compared to capital and to balance sheet, right? Now, sorry, Dr. Sean, the second element that I think it comes into play is now the traditional organizations, traditional custodians, they already had the access to do crypto custody through the OCC years and years ago.
Yeah.
They were just limited by this accounting standard.
Yeah.
With the standard going away, what I do anticipate seeing, and if we're sticking with the term of trends
Yeah.
that we expect in the next year, 2 years, I do anticipate seeing a lot of traditional custodians entering this space and putting out their custody solutions, whether they do that via development of custody solutions or consolidation with other existing custodians, that's to be seen.
Great.
No, and I think Malik really did hit a few of the core points there, and that the issuance of SAB 122, I think, is really just emblematic of the overall policy shift from headwinds to tailwinds. And even just in the last few months, there has been so much interest and development and then launching of on-chain solutions for custody, trading, other client advisory services in the TradFi space, that I would say that probably within the next 12 to 18 months, there's only going to be more, and there's probably going to be more sort of cross pollination between TradFi firms having their own products, partnering directly with firms that are in the crypto native space, which is just about starting. I know Chase recently, they are quite careful by highlighting the fact that their transactions weren't on a DeFi network, but they were dabbling in that DeFi space. So I'd say that, I think SAB 122, it almost sort of leveled the playing field for how firms can hold on to assets.
Yep. Excellent. And Cassie, maybe I'll ask you, you've been at multiple places crypto-wise. From an implementation perspective, was there literally a tone change in terms of the actions that finance teams were taking? As you hear, we had SAB 121 and it's 122. Did people open up? Were there implementations that you experienced?
Yeah, so in the background, on accounting teams, I think with SAB 121, the tone was panic, right? There was just, the guidance came out in terms of people entering the space and the reserve requirements and all of the things. And so for people who were already in this space, getting to the point of being compliant and when are we going to adopt it and how are we going to do it and how are we going to make sure that when we adopt it, we only have to do it once, or forward-seeking to say, is this going to be repelled and we're going to have to reverse it?
Yeah.
What's the correct strategy? So when it did get, when SAB 122 did come out, it was just like a sigh of relief of like, okay, this is over. Let's kind of go back to what's going to be the long-term game here and how we can keep this compliant.
Yeah, and Malik, when we were talking about this, I think you stressed the point that's worth discussing around SAB 122 wasn't an opportunity to sort of bypass the guidance and by default make a decision. It's all off balance sheet because they said there is still analysis. Maybe I can ask you to say what is that analysis that you're doing to make that decision?
Absolutely. I'll just do a quick 30-second there, right? I agree. Like SAB 122 is not an exception. It's not a case where, hey, 122 came out, everything's all balance sheet, we're moving off. The accounting fundamental that created this whole thing is ultimately down to control of the assets. Each of the regulators believe with that. AICP has an entire paper on it, FASB, SEC, they all have that. It goes down to the fact, do you control the assets, yes or no? And if you, the custodian, is still controlling the assets, then they still remain on the balance sheet, not as customer assets, but as assets that you are holding, with then an obligation for the customer. So that's the nuance where still stick true to the accounting principles, which go to the fundamentals of who controls the wallet, who controls the keys, who can restrict access to the wallet, so on and so forth, as compared to directly bypassing and saying, yep, everything's off balance sheet.
Awesome. Before we flip from that topic, any last things to say on that topic? Okay, awesome. Okay, I think we're up to date. The next topic on our list was ASU 2023-08. And I think we sort of wanted to couple it actually a little bit with stable coins because there's sort of like a relationship with how do you value stable coins. We know that, well, in theory, they are stable and they're backed. And so maybe you say, hey, everything is $1, but in practice, if you try to do anything with a stable coin on an exchange, you'll see that there's a little bit, it could be 99 cents, it could be 98 cents. And if you think about the history of some of the stable coins over time, they're different types. And not all of them can you trust to be that. So I think we want to connect stablecoins a little bit with the fair value standard, so to speak. And so I'll ask the first question to Dr. Smith, which is give a little bit of orientation on...
Going first again, love it.
Yeah, give a little bit of orientation on what was that as a standard,
Sure.
and then we'll jump into how it connects to stablecoins as one example.
So I was so happy when I first heard that the FASB was finally going to do something around crypto accounting generally, because I'm sure all of us have been advocating, pushing for some sort of standard on this topic. And then as it got closer and closer, I became less and less happy, right? Because the whole scope and the impact of the ASU got so narrow and so pointed that it's basically just for companies holding Bitcoin and Ether on their balance sheet, which is helpful, which is definitely helpful. But there's so much of the crypto asset ecosystem that is not covered in the ASU. And basically, in the ASU, it was a big step forward because now if the tokens hit the qualifying criteria, again, mainly focusing in actuality, Ether and Bitcoin, then you can hold them at their fair market value as opposed to cost minus impairment, which was always wrong. But in terms of how fast the whole ecosystem has grown, DeFi, staking, NFTs, privately issued stablecoins, STOs, and any assets that are tokenized, all those aren't covered by the ASU, right? And I do think it was a great first step, and it has helped us try to sort of push a conversation forward. But as we see all of these entities issuing stablecoins, using stablecoins, doing tokenized payments, there are even U.S. Treasuries that are on-chain tokenized. So how do we account for that? Now, ideally, it would be as a cash equivalent, but we don't have the guidance there yet. So I do think, one, it was a great first step, but two, Cassie, there are a lot more questions.
I was just going to say this kind of ties back to what we were just talking about, where with SAB 121, there was good intent. We know we needed something. Something came out, didn't work. Okay, let's try again, right? Let's clarify. Let's get some more information. And so kind of the same thing with 2023-08, where, okay, it started out, it's kind of vague, it's something, and based on implementation and how it's being received, then we can say, okay, this is why it doesn't work, and this is what we need to change. And we're not going to get to that point unless we have something to start with. And so a good starting point was needed for sure.
And if you're being honest about it, right, the 2022-08 came out because the Bitcoin ETF and the Ethereum ETF have to be launched. That's it. The fair value element aside, the balance sheet disclosures are all structured like an asset management fund complex disclosures. So that was, and it was to your point, Casey, good intent. We had to move forward. ETFs were important. We had to get there. But now that standard needs to evolve a bit.
And I guess let me ask the question. So we've got Bitcoin and ETH sort of covered. So what do I do with my NFTs? What do I do? I mean, my Sol, my AVAX. What's my move with that? Since the guidance is maybe not as clear on that, or maybe.
It depends.
Great.
Nailed it.
It depends on the token. I mean, so you mentioned a number of tokens, right? The treatment for Solana versus AVAX versus USDT versus BUIDL would all be different. Because these are all tokens which are different in nature, different in structure. They meet certain scoping guidelines. Some of them might be fair value, some of them might not be. It is a detailed evaluation that needs to be performed. So as true accountants, I would always say it depends. Go ahead.
Especially because, so we were talking about stables, and it's still, even within what we term as stables lightly, what is actually a stable and what is actually an asset or a token can sometimes be confusing, like with USDT, where everybody just kind of like thinks of it as a stable. And so all of them have to be analyzed individually.
And adding on to those awesome comments, I would say that even just at a more basic level, from a investor point of view or from an analyst point of view, do we actually understand how these tokens operate, where they're traded, are they going to be L2 or L3 assets in some cases, and then just the basic tokenomics as to how these tokens work, right? Because that then in turn can also influence how they're valued, how they're treated, and all of that good stuff.
Yeah, I'll ask, so as an implementer of Bitwave, and we meet lots of customers with a lot more than Bitcoin and ETH, I will say that. It is interesting because different decisions are being made by different finance teams about the same asset, which we love at Bitwave because we have the capability to support, however you want to do it. My question is that ideal end state-wise? Is it, yeah, you should make your own independent judgment, or is the nature of these things is, a vax, the nature of it is what it is, so the answer should always be the same no matter what company it is? Or I'll open that up to who wants to take that, but the question is that actually the ideal end state? Or should there be, would you say you want finality and very, that level of precision on each asset as to what should happen?
I think the heart of accounting is it depends. I don't think anybody does everything exactly specific unless it's some, even most GAAP principles have gray area where most people do it one way, most companies do it one way, but it just doesn't fit that framework.
Yeah.
And so I think that I think the core of the question that you were asking was valuation of stable coins, and if there's like one specific way.
Yeah.
And I think that there is a generally accepted way for what you're holding it for, operationally versus trading. Yeah. And there might be reasons to vary from that, but if you do need to make a change, I think that that's going to be because of another influencing factor or something that you're going after with investors who want to see it a certain way.
Yeah. Dr. Smith?
I would just add there that it always does depend, right? Absolutely. But that it also, ideally, I would think for our conversation here at Bitwave or our companies or going out there doing advisory work, trainings, all the rest, it's always good to have multiple answers, and that it depends. But from a industry point of view, from a market structure point of view, it is going to be better, I think, ideally, to at least coalesce around how certain assets are generally treated, right? Be they stables, be they NFTs, which are coming back apparently, or any other type of on-chain assets, in order to get that mass market understanding, in order to get us on that stage at that conference mentioned earlier, CBOS. There have to be not hard and fast rules for everything, but there have to be best practices as to how to value, how to treat, and how to disclose on certain categories of assets, I think.
I agree, and I think tokenized assets coming on, that's going to be one of the big triggers for that. Because when you think about some of the traditional currencies, like, again, AVAX and Solana and whatnot, they are tokenized representation of the blockchains, which accounting still doesn't really understand. But when you talk about real-world assets, hey, this is the tokenized representation of that building over there. You know how to value that building. So I think when you talk about like some of the synergies or sort of some of the commonalities that come in, like once RWAs start coming on the balance sheet, I think that's when you're going to see some more reinforcement on, hey, these type of assets are valued this way. These type of assets are valued differently.
Got it. Okay, awesome. I'll drill a little bit more into stablecoins, and I think I want to go into in the company setting, right? You have an environment, and I guess this is the story of crypto in general, right? Which is that there's regulation, there's some standards. It applies to some things, it doesn't apply to others. But as a finance leader, you have to, when I show up to implement, I have a question for you, which is like, I need to know how you're going to treat BTC, and I need to know how you're going to treat FX. So you have to make some kind of decision. I'm wondering, how do you think about the process around that and making sure that you're making a decision that you can defend later? And I'd love to hear that from like a in practice finance leader standpoint.
Absolutely. So when deciding how to value a token or an asset, you have to decide where it's coming from, how you're getting it, if you're going out and buying it, if you're trading it, what the purpose of it really is for. And then at that point, understanding consulting with people, if it's not something that you're familiar with or you kind of have experience from the past on best practices, brand new product or market or something, consulting with the market with people who have done it and to see like what worked for you, what didn't work for you, whether it be consulting firms or I don't want to say competitors, but
Peers.
yeah, peers. That's what I was looking for.
Yeah.
And making a decision that way, but also understanding that like, hey, this might change later. We're going to do this for now, and we've got to be flexible if something happens because everything crypto is ever changing.
Yeah, awesome, very helpful. There's maybe one more topic around trading activity, EGCs, those that I think was an interesting one, and I would love to take it using an example. Okay, so the example we talked about earlier was I'm just retail, right? Like, and I'm going to buy BTC. Now there's an exchange of some player that I'm buying 10 BTC on. I'm trading. Walk and Malik, I'm looking at you, and then we'll spread it out. Walk me through what that means for them in terms of from an accounting standpoint and some of the FASB guidance, and then we'll go a little bit deeper there.
Okay, so I've got these debits and credits post. I'm just kidding. I'm not going to go down that path. I think like fundamentally, when we were talking about the standards that have come out, how they're helping, I think this is another area that is needed, like an evolution is needed. The FASB or the regulators need to start thinking about it. So sticking with your example, all right, like when you go and buy something on Coinbase, right, you give them $100,000 and you bought one Bitcoin. For you, whenever you sell that Bitcoin under the IRS, you have a gain or loss, which is taxed. You are not taxed on the $100,000, you're taxed on the gain or loss. For that counterparty, however, a broker-dealer, OTC trader, trading desk, whatever you want to call it, the way the current accounting standards work, if they are a broker-dealer who just did that transaction for Amazon, they will just record a net revenue. They bought an Amazon share for $8 and sold it to Ori for $10, and they recorded $2 revenue. That's it. For a digital assets broker-dealer, because we are not traditional finance, because we are treated as tables and chairs, technically, from an accounting standard perspective, you actually record the full $100,000 as revenue, and then you record a 99,000 XYZ amount as cost of revenue. And what that does is, on the hindsight, if you think about, go back like 5 years and think about all the tech startups, and they wanted to have massive amounts of revenue because valuation was always driven by revenue.
Yeah.
For those companies, it made sense. They were SaaS. SaaS revenue is the king.
Yeah.
But for a broker-dealer where investors, analysts, your organization itself, FP&A, everyone is looking at the spread, that grossed up revenue doesn't make any sense. And then the real world impact of that, when you're starting to think about an SEC transaction, starting to think about IPO, more often than not, you will be ejected from the Emerging Growth Company Act, which means that you will need to be controls ready when you're going IPO. You will need to have 3 years of financial statements. It's a lot more effort that goes in just because of an accounting standard misapplication. I don't want to say misapplication because that is the standard.
Yeah.
But it doesn't reconcile with what the business practice, what the market practice, what the intention of that transaction is.
I think it's like I learned a little bit better when we were having this conversation, and I think it's sort of, I wouldn't say ironic or interesting, because it sounds like this is a situation where you want it to be defined as a security because it provides you those
You
benefits.
can get into the accounting standard.
But in the other situations, we don't want it. So, Dr. Smith, which is it? Do we want it to be, or do we not want it to be? And don't say it depends.
It depends.
So sort of interesting, and I think the point is that it's finding the right fit regulation for the right timing and all of that, and we're having the evolution in that direction. But maybe with a minute or two left, what didn't we talk about? We talked about 3 sort of core topics. Anything else lingering this year that hey, the team here should think about regulation-wise, or something you want to double down on that we went through?
What I would say there is that anything to do with 1099 DAs is going to be a tremendous headache. So just heads up.
Start consulting now.
Awesome. And I'll give you the last word.
I think we're going to see RWAs this year. I think the ATS trends are going to continue. So for me, the biggest thing to look out for this year is going to be more enhanced guidance on trading activity and hopefully more enhanced guidance on valuations.
Awesome.
That's what I'm looking forward to.
Okay,
As
awesome.
an accounting nerd.
Awesome. Well, thank you guys so much for walking us through that.
Excellent.
Thank you.